everyone, my name is Basma and this presentation is for LP2 assignment financial statement presentation. So now we will talking about the financial statement, balance sheet, income statement, cash flow statement, and financial rating. Financial statement. Financial statements are right record that cover the business activity and the financial performance for a company. Financial statements include the balance sheet, income statement, and cash flow statement. So the financial statements are often audited by the government agency accountants firm. Also to ensure accuracy and for tax, financing, or investing process. Income sheet. It is a financial summary that determines the result of the company within a specified period and is used more than data covered once year and ending in a specified period. Income statement and the statement of cash flow is conducted by fundamental analysis to conclusion financial write-off. So, an income statement is one of the most important financial statements used for reporting a company financial performance over a specific period. That income statement primarily focus on a company revenue and expense during all the life of the company. The income statement focuses on the four key items: revenue, expense, given, and loss. So the income statement is the most important financial statement used for reporting a company financial performance. Over a special period, the income statement primarily focuses on a company revenue and expense during practical period. The income statement focuses on the four key items: revenue, expense, gain, and losses. Essentially, it's given an accounting of how the net revenue realized by the company gets transformation into net earning, profit or loss. The net income is collected based on the following: net income, it's revenue plus gain, expense plus loss. Revenue, it's all the sales generated during the year. The expense incurred and the profit earned. Expense consists of each outflows. Example of expense include cost of goods, also materials, cost, salary, and expense for research and development. Balance sheet. A balance sheet is a financial statement that reports a company assets, liability, and shareholder equity at a specific point in time, and it provides base of company rates of return and evaluating its capital structure. The balance sheet provides an overview of assets, liability, and stakeholder equity and a snapshot at a time. The date and the top the balance sheet tells you what the snapshot was taken, which is general the end of the financial year. It is used along with other important financial statements such as income statement and statement of cash flow and conduct fundamental analysis and or collecting financial data. So the formal use for balance sheet in this picture is that example from the book. Assessed. The order of account from top to bottom means the liquidity of the bank and its over, and it is a reference to current assets that can be converted into cash is 1 year or the long term and can be not convert assets the company is individual into current assets and current liability, and this short term can be paid within 1 year. So assess its liability plus owner equity. Shareholders' equity is the money attributed to a business owner, meaning its shareholder. Liability are the money that a company owes to outside parties from bills it has paid to suppliers. So the current liability account might include bank attributed insert pay bill, rent tax, wage paid, customers permanent, individual payable and other, and current potential for long-term debt. So the balance sheet total will be collected by identifying it. First, located total assessed on the balance sheet for the period. Second, total all liability which should be spread listing on the balance sheet. And located total shareholder equity and quit and added the number to total liability. Final total assets should be equal the total of liability and total equity. Cash flow statement. This is a summary of cash flow during a specific period. This statement to provide a summary of opportunity of operational financing and investment flow as well as a change in the company cash debt. The cash flow allows investors to understand how the company operations are running, where the money is coming from, and how money is being spent. So the cash flow statement measures how well a company managing its cash position, and that is mean how well the company gained cash to pay its debt or obligation and fund its operating expense. The cash flow statement complement the balance sheet and income statement and it's a mandatory part of the company financial report since 1987. The main components of cash flow statement are cash from operating activity, cash from investing activity, and cash from financing activity. So here is some example of operating activity, investment, and financing. Operating activity, for example, includes the net profit after tax depreciation and increase in company account. Investments include all the company investments such as buying and selling long-term investment account. Financing in financial department contains information about the company financial operation include share and profit payment. Financial ratios. It is used to analyze the preparation of the company financial statement in terms of analysis of insert to shareholders, management of the company and the creditation. This helps them to know the risk and return relation to the company at the present time and the future. Categorize for our financial ratios. First, liquidity. Second, activity. Third, debit. Four, profitability. Four, fifth, market ratios. So, liquidity, activity, and debit ratios primarily measure risk. Profitability ratios measure return. Market ratio capture both risk and return. So, In the general, all the effects of the share price the firm creation are insert primarily in the short-term liquidity of the company and its ability to make insert and principal payment. On the other side, the creditors they want ensure that the business is it's good and without any cheating. And the management, like stakeholder, is considered with all aspects of the firm financial situation, and it attempts to produce financial ratios which will be considered favorable by both owner and creditors. In addition, management use ratio to measure the firm performance for period to period. This is a reference page, and thank you for listening.